Okay, so it says financial statements. Each of the following items is shown in the financial statements of ExxonMobil Corporation. First thing it wants us to do is to identify the financial statement, balance sheet, or income statement in which each item would appear. So in here, out of this list of 15, everything is going to either go to the balance sheet or the income statement. Accounts payable, that is a liability. Okay, that's going to show up on our balance sheet. So the balance sheet shows this as of a specific date. It shows all the assets that we have, all the liabilities, and all the owner's equity, and they all must be equal. So that falls on the balance sheet. Cash equivalents, crude oil inventory, that's an asset. Inventory is an asset. Equipment, that's an asset. Exploration expenses. Anytime we see anything that says expense, we know that it belongs on the income statement. Okay, so the income statement, also known as the profit and loss statement, starts out by showing all the income, then it shows the expenses, and the difference between those two is our profit. Okay, income taxes payable. Anytime you see a receivable or payable, you know that's going to belong on the balance sheet. So income taxes payable, those are income taxes that we owe but that we have yet to pay. That's a liability, belongs on the balance sheet. Investments. So these could be anything from investments in other, small investments in other companies to maybe pieces of real estate that the company holds that it plans to sell later. Okay, so that is an asset. Long-term debt, of course, is a long-term liability, so it also belongs on the balance sheet. Marketable securities. Okay, so these are things that we have, securities like stocks that we have and other companies that we plan on not holding on to for a really long time, but we're hanging on to those things, and if the timing's right, we'll sell them. So those are an asset. Notes payable. That's a formal amount that we're going to pay typically later down the road. It's not always, there can be a component of it that's short term and a component that's long term. But typically, this stems, it's a very formal note. It's a lot more formal than just an accounts receivable where we do business with somebody and we sometimes deliver goods to them before we receive payment. This is very formal where we've sat down and actually written a note out, a written agreement. Okay? A notes receivable would be just on the flip side of that. You would actually be the person that has lent the money and you're waiting to receive it. Both of these are good. This is an asset and this is a liability. However, both show up on the balance sheet. We have our operating expenses, income statement, prepaid taxes, asset, sales. That's our revenue that belongs on the income statement, right? The profit and loss statement. So we show our profit and loss as well as these selling expenses. So then it says, can an item appear on more than one financial statement? Well, you won't. These either belong on, in this list here, everything here either belongs on the balance sheet or the income statement. Now, in some circumstances, well, here's a great example. Cash. Cash would show up both on the balance sheet and the statement of cash flows. But in most circumstances, there's not going to be an item that's going to show up on the income statement and the balance sheet. It's typically one place or the other. The whole world of financial accounting revolves around the accounting equation. Even the most complex transactions all must uphold the accounting equation. Let's go down here. 1.3a. Okay, so this is what the problem that we're going to take a look at looks like. So we have our cash. This is the ending balance here. Ending balance of accounts receivable, supplies, accounts payable, right? So we go on and on and on and on. Now it asks us here to prepare an income statement for the month ended March 31st, 2012. They're going to prepare a statement of retained earnings and a balance sheet. And lastly, if we have time, we'll do a statement of cash flows. Now the first statement that we need to prepare is an income statement, okay? And this covers a period of time. In this case, this is covering a month ended. So just 1 month ended March 31st, 2012. So we can tell from looking at the information that was provided that we earned $118,500 worth of fees. So that's fee income that we charged people. So that's how much we earned. Our salary expense was $48,000. Our rent expense was $22,500. Auto expense $13,500. Supplies was $4,500, and miscellaneous expense was $3,600. Total of those expenses is $92,100. So we made $118,000 $118,500 in sales, but our expenses were $92,100. So that means that we have $26,400 left over as net income. So this is how profitable we were. We made this much, we spent this much, and this is the amount that we would have, the difference between the two, which is known as our profit or net income. Okay, so we're going to take this net income figure here, and we're going to come on down. We're going to plug it into the statement of retained earnings. Okay, so we started out, we're assuming that this is a new business. I think this was the first month of business. So we had no retained earnings to begin with. We added our net income of $26,400. We paid dividends of $15,000, right? So we know that dividends reduce our equity. So what we're going to have to do is we're going to start with 0. We add $26,400. We subtract $15,000. That leaves us with an $11,400 balance. This was the increase in our retained earnings. Our beginning balance was 0. So in this case, our increase happens to equal our ending balance. If this had an extra $100 up here, just for example, then our ending balance would have been $11,500. Okay, so we're going to use this number here, and it's going to show up right here on our balance sheet, which is as of a specific date, right? So this is also for a specific period of time. The statement of retained earnings, this is for a specific date. We have all of our assets listed out here. The total of those 3 different assets is $61,140. We have our liabilities. Now all these figures were given to us on the other page that we briefly looked at, right? The problem gives us all these balances, and we just are assembling these into a proper financial statement. Okay, we have capital stock. We're told $45,000. $11,400 is our ending balance of retained earnings that we calculated up top. Total of those two gives us our total equity, $56,400. If we total our equity with our liabilities, we're looking at $61,140. Guess what? That equals our total assets. No matter how complex and how crazy the transactions of a company might be, assets are always going to equal the liabilities plus owner's equity. And remember, we're using accrual accounting, so we're recording the income and expense when we're incurring these, not necessarily when the cash is exchanged